A bank takes money from their depositors. And what do they do with it? They don't just sit on it, they lend it out. Well, they've got to pay their depositors something. That's one of the ways they attract depositors is I'm going to pay you an interest rate on your money, on your savings account. I'm going to take most of that and I'm going to lend it back out to businesses and others and individuals even at a much higher rate. And that spread is how I make money. The problem is when the economy slows down, what happens to my lending? Well, my lending goes down. If interest rates go up, the cost of lending goes up, right? The cost of that money, borrowing it from depositors, goes up. And so you see this constant ebb and flow of banking revenue and banking earnings. Executives have been trying to figure out a way to normalize that just a little bit more. They're always going to have a little bit of that ebb and flow. But how do I get that to be a little bit more predictable and a little less volatile? Well, it's going to be about non-interest income. So you have the interest income, which is the spread between the lending and the depositors. Now this is all the other income that I can get, all the other revenue that I can generate. And a lot of things that they're looking at are fees. They're looking at providing other services. So a bank that was just lending may now offer other credit card processing or other fees to a business. And they're just entering into different lines of business as well. So with this trend in more resilient fees, there are a couple of ways of looking at it. First of all, as a consumer, whether you're a business having a relationship with the bank or you're a consumer that has a relationship with the bank, watch for those fees. Now, it is a bank trying to normalize those things. And as someone that works in banking, I'm going to do my best to generate additional revenue, especially when the traditional interest income is going to be a little bit more pressured. That also means if I'm seeing more volatile revenue and my bank hasn't looked at fees and other lines of businesses, when interest rates go up and lending slows down, there's going to be a big emphasis on that cost control. And you may see banks ultimately cut costs as they try to weather the storm where they're paying more and they're lending less. So again, look at your bank, understand where the market's going, understand what your initiatives are on that banking revenue, whether that's traditional interest income or these non-interest income. Make sure that we're maximizing that. And just like every other year, make sure you're really careful on those costs.